I'd like to go over a little bit of a look back and mention a few things about some of the subjects which you may have some memory of. Hopefully the word is probably as opposed to merely may have. More likely than not, you know, there's, remember, substantial authority. More likely than not, and, a reasonable basis, and you know, all those terms which you should by now know and love. Okay. We'll attempt to spend a few minutes on each one of these areas, and then we'll start in the few minutes we have left, and then finish up that next time and start foreign tax credit. Refresh your memory on a few things here. Okay, what's domestic and what's foreign? And in the U.S., that's normally pretty simple. The U.S. has very bright line rules. Are you a citizen? Yes or no? You're a citizen, you're taxed in a certain way. You're a non-citizen, okay, then you have specific rule to decide whether you're a resident alien or a non-resident alien. Very bright line. For a corporation, are you a U.S. corporation or not? Bright line. Are you organized in one of the 50 states or under federal charter? Yes. Are you incorporated in Bermuda? You're not a U.S. person. Very simple and straightforward. Other countries generally do not have such bright line tests. You cannot assume that a company, merely because it's incorporated in a certain country, is a resident of that country and taxable on worldwide income in that country in the way that you know that a company incorporated in the state of Washington is taxable on worldwide income by the U.S. The U.S. is relatively unique in this sort of bright line test. A few accounting terms which hopefully you ran into when you were studying which aspect during inbound. Any ideas? Looks like Greek. This is the classical thing we were talking about. Okay, when you were studying the sourcing rules, think back. When you talked about source, were you talking about gross income or net income after expenses? Gross? Okay, now you're saying gross in a relatively tentative fashion. Why did you decide to say gross?
Well, definitely the 871 was on gross. But before that, I think it's because the deductions only come into play if it's taxable within.
Well, you're getting to the right thing. The point is that what you were referring to, okay, 871 has, if you'll recall, an A section and a B section. Anybody remember what A covers and what B covers? Okay, A is non-effectively connected income. B is effectively connected income. What is the taxation method for 871A? 30% of gross. Yeah, 30% of gross. What's the taxation for 871B? Effectively connected income? Yeah, net income. Net income at whatever the normal, let's say, resident tax rate is. So we see that there's a difference. Sometimes gross income is the basis for taxation. Sometimes net income is the basis. Now, if we look at your 861 through 865, those are your source rules. And if you look at 861, that's income sourced in the United States. 862, income sourced outside the United States. You will see that they are talking about gross income. And it makes sense because where you incur an expense might or might not have any influence on what the source of the real income item is. If I create an intangible property through my research and development efforts in the United States, and then I license the intellectual property I've created to somebody overseas, and they use it in a foreign country, what's the source? Okay, it's foreign because the rule for a royalty is where is the property used? Now, that's the source in the domestic U.S. law, but it might not be the source of the foreign country. It might not be the source that's indicated in a tax treaty between the U.S. and the other country. There's nothing innately right about the source rules the U.S. has. It's just the choice of what they put in the law. But getting back to this point of gross income versus net income, where it's used becomes the source of the income, and that's really, in a sense, a gross income concept. That's where are the proceeds coming from? I spent all my money to create the intangible in the United States, but that's ignored in the source decision. We'll start now looking back at the entity classification area. Now, I'll spend a few minutes on this because this is such a basic and important area for Outbound. Every time you look at any sort of a situation that involves a U.S. person, whether it's an individual, a company, or otherwise, that has any interest in a non-U.S. person, this could be a partnership, this could be a foreign corporation. Anytime you have this situation, you always have to ask yourself, well, how is that going to be treated when I analyze this situation for U.S. tax purposes? It used to be that this situation was based on the characteristics of the entity. Used to be. That's this prior to 1997, when there were 4 factors that you analyzed by looking at the underlying law in the country where the organization was established. You looked at its organizational documents. Did the organizational documents allow free transferability of interest, or limited liability or whatever the point was that you were looking at. So previously, the character of an entity for U.S. tax purposes was dependent on the characteristics of the entity. 1997, that all changed. And the rules, hopefully you're familiar with this name from last time, the check-the-box rules. And why are they called the check-the-box rules? Because it's your choice. Assuming you have an eligible entity, and most entities are eligible entities, it's your choice. Whatever that company decides, assuming it's a 100% owned situation, whatever that U.S. company owner decides will be what happens for that company. So it no longer is based on the characteristics of the company. It's based on the mere choice of the investor. And this can go, each way. If it's a corporation, as long as it's an eligible corporation, or an eligible entity, as the term is, then you can choose it to be a corporation for tax purposes. You can choose for it to be either a partnership or a disregarded entity. And we'll talk a little more about what that is. But it's your choice. If there's a number of owners, then the owners have to agree as to how this entity will be treated. So that means up front, if two parties, for example, are negotiating a joint venture, then that's an item that has to be thought about and agreed ahead of time. Because different parties, might have different desires. Now, one thing which I was talking earlier this evening with Christine in the class about tax policy. And tax policy, of course, decisions on tax policy not necessarily going where the drafters thought they would go. Implications of change going from the prior one to the current one. The prior one, that was complicated. You had to make a separate analysis each time you looked at a new entity, and you'd say, gee, is it going to be treated this way or that way? And most of the time it was pretty obvious. And so it wasn't a big problem, but obviously it was a complication. So this was billed as simplification. Just make your choice and that's it. And yes, it was simplification in that sense. But as you'll see as we get further into the course, it spawned new complexities in all the planning that can be done to come up with the best answer for whatever the business objectives are. And it's really complicated things from a student standpoint immeasurably. From a fun standpoint, it's a lot more fun now because of all the things that you can do today which you could not do before. So it's become much more complicated to learn. It's become much more complicated from the standpoint of the IRS in terms of trying to deal with this. Because taxpayers are doing all sorts of crazy things. Now, the basic format of the rules, if I remember correctly, in the recommended, or I guess not recommended, the sheet you have in your book, which is probably labeled something class reading assignments and other assignments, I think I said in there that recommended reading, but strongly recommended, is the 7701-2 and -3 regulations. Those are worth reading. You'll see as you get into it, there's some parts that are very, very wordy, and you can get through those almost by scanning. They're not particularly important. But the crux of it, as you page through it, you'll see is in relatively few words, and it won't take you very long. But they're very important and highly recommend you become familiar with them. Now, one of the basic concepts is that there's a listing of types of entities that these new rules say you don't have a choice. They have to be treated as corporations. And you've got a listing in the regs which give you for each country if there is an entity that is like that. And if there is, and that's your entity that's already been made, already been formed, best example is a very common vehicle in Japan, the KK, Kabushiki Kaisha. That is a per se corporation, and under these rules, you don't have a choice. It must be treated as a corporation. But if it's not on that list, then by definition, it's an eligible entity. And being an eligible entity, you now have a choice. And what are the choices? If it's a single member, or it's only one owner of that entity, then you have a choice. Corporation or disregarded entity. What's a disregarded entity? Anybody? Yes?
Sole proprietorship?
Effectively, yeah. A sole proprietorship for an individual, yes, would be a disregarded entity.
But I guess it's anyone that has the benefits of flow-through taxation.
I'm sorry?
So it's anyone that has the benefits of flow-through taxation, right?
Okay, that's a good way of saying it. That yes, if you have a disregarded entity, then there is flow-through, transparent treatment to the owner. If you set up your own law office and you do it in your own name, you don't form a professional corporation or some entity like that. So you get the same result, even if you have an entity where you've made this election to treat it as a disregarded entity. Just transparency. For a corporation, if we're looking at a corporation situation like this, it means that this, from a tax standpoint, this line does not exist, and that for tax purposes, all of the assets, all of the liabilities, all of the income, all of the expenses are considered for tax purposes to be owned by the U.S. company. It's just like a division of the U.S. company. Okay, if there's two or more members, then the choice is between a corporation or a partnership. And partnerships, hopefully you've had at least some sort of introduction to the partnership rules. So where you treat something as a partnership, you know, okay, under the 700 series of code sections, income flows through, it's transparent. And that partnership entity can make certain elections as far as accounting methods are concerned and so on. And there's certain filing requirements. So you're pushed into that if you choose to have a partnership treatment. So this is something that we see very, very often in the international area. Very, very often. And it is, again, as we get further into the course, you'll see how you can always choose whether it's going to be one way or the other, and you get different results. Which one's better for your situation? There's a form I would certainly recommend, sometime just looking at the form on the IRS website so you see what the thing looks like. One of the very short parts of the 7701-3 regulation, very short part, is the default rule. And that's something which, again, you should know, you should have looked at it at least once. You don't have to memorize it. The point is, know where it is so you can look at it. It's very, very short, even if that's the only thing you look at when you look at your 7701-2 and 3 regs. The point is that the default rule in just a couple of lines says the following. If you don't make an active election, if you don't file the form and make a positive election, then this is the result. That if there's 2 members and at least one member has unlimited liability, partnership treatment. If you have only one member and that member has unlimited liability, disregarded entity. The usual situation that we see very, very often, of course, is that all members have limited liability because most of the time, because of limited liability concerns, the eligible entities used by people when they set up companies are limited liability entities. So this default rule is very simple. If nobody has unlimited liability, then it's a corporation. That's your default rule for foreign eligible entities. There's a different default rule for domestic eligible entities. And again, it's just a few lines. Look at the reg and read it. Know that it's there. Know where it is so you can go back to it. Because this is by far one of the most important areas. I'd like, even though we've talked a little bit about the fact that a disregarded entity is transparent, I'd like to go a little bit more into what the meaning of this thing is, not just for tax purposes, but for other purposes as well. Notice what I've set up there. Under local law in the country of the establishment of this entity, and everywhere else, including the U.S., except for tax issues, it is an entity established under some law which has legal effect, and the fact that we have made an election to treat it as a disregarded entity does not affect any of those things. There's still an entity there that can contract. There's still an entity that is respected as a juridical person by everybody in the world. It is only in the preparation of your U.S. tax return that you pretend that this fiction is real, that this disregarded entity is disregarded. It's only in your U.S. tax return. It's nowhere else. I certainly have seen that people have a tendency that when there's a disregarded entity status, that there's sort of a natural reaction to think, well, that's the way it is in reality. But it's not. It's still a juridical person with all of the rights, responsibilities, obligations, everything else that goes along with going through the procedures of setting up an entity, maintaining it, having it contract, do things in its own name, and operate. It's only for the U.S. tax return that this is ignored. You run into this terminology reasonably often. Hybrid entity and reverse hybrid. And a hybrid is normally a partnership or disregarded entity for U.S. tax purposes, but of course a corporation under local law. In other words, a taxpayer under local law. Separate taxpayers. Reverse hybrid is the opposite. It's a flow-through or transparent entity under local law, but you've chosen to make an active election to treat this for U.S. tax purposes as a corporation. So you run into these terms. The most common thing we see is the hybrid entity. It's not as often that we see the reverse hybrid, but that is something that can be very important. The obvious question is, why are hybrids or reverse hybrids useful in the international context? And we need to think about this from the standpoint of maybe an individual. For corporate members also. Now, just as a simple example, let's assume that this down here, which we'll call X, let's assume that the individual owns it 100%. And let's assume that he has made an election to treat this as a disregarded entity. So that it is such as, I think, that's Mark. As Mark suggested, this is to be treated like a sole owner's proprietorship. Now, let's assume that country A has a high tax rate. Let's say that X makes 100, pays 40 of tax to the local government, and there's 60 left over. Any thought as to what the result might be for our individual owner in this situation where he's made the disregarded entity election? We know that X is a real, live corporation. If you went and talked to the tax authorities of country A, they say, hey, the taxpayer is company X. Company X has paid 40 of tax on 100 of income. We're happy. What about when, want to give them a name? I don't know, Gonzalez? We'll call him G for short. Okay, when G files his U.S. tax return, what will he do? Any ideas? You look like you want to say something.
He'll pay tax on the $60.
He'll pay tax
Well,
on...
he'll have income of 60.
He'll have income of 60. Okay, and how did you get to that?
That's the net income of the entity.
Okay, that's the net income of the entity. Okay, but let's go back a moment. Again, because we have this fiction of the disregarded entity, what is G's gross income? What is G's gross income under Section 61? Yeah, 100. Is there a section somewhere in the code which says you get a deduction for foreign taxes? Well, yeah, you're saying he might choose the credit. Yeah, that's sort of the next step. First is, yeah, if he wanted to, he could deduct the foreign taxes. Okay, now, if he wanted to, Ricardo, he could do what?
Get the foreign tax as a tax credit, right? Local return, like U.S. tax return.
Yeah, on his U.S. tax return, because of this fiction that this box does not exist, because of that fiction, when he goes to prepare his U.S. tax return, he'll show 100 of income. Let's assume the U.S. tax rate is 35. He will then claim a foreign tax credit of up to 40. Now I'm ignoring the foreign tax credit limitation and all the other nonsense we will get into later. But he will take a foreign tax credit of at least up to 40 because he is treated as having paid 40. As far as the U.S. is concerned, X does not exist. Because X does not exist, X is not the taxpayer. G is the taxpayer. So, as a result, he's going to pay 0 U.S. tax. Yes, Ricardo.
What if he's disregarded, so he doesn't exist? Why he can't? So he doesn't claim the credit, right? Or no?
Well, no, just a second. He exists. G exists. It's this box which we pretend, under the check the box rules, we pretend that this box does not exist solely for purposes of U.S. taxation. So, his income is considered to be 100. His gross income is considered to be 100. He is considered to be the taxpayer for 40 of tax. Now, his name will not be on the tax return. Company X's name will be on the tax return. But because of this fiction, this disregarded entity status, this 40 is treated as his personal tax. It's treated as he's treated as the taxpayer. He's the one who can claim, as you said, a foreign tax credit. Pardon?
It will be 25. Why it's 0? 35
35 minus 40 is minus 5. No?
I just
Minus, yeah.
calculated like 35 or 100, it will be, 35, 100 minus 35, it will be 65, and 65 minus the, or in tax credit, it will be 40.
Oh, okay, I'm sorry. This is the gross income. The 35 is the tax. In other words, a 35% tax rate. So it's, to get to this number, it's 100 times 35%, 35. So we're saying the tax is 35, the U.S. tax before foreign tax credit is 35, and then the foreign tax credit, $1, and again, we'll talk more about it later, but dollar for dollar benefit against the U.S. tax. And we end up with an actual payment to the U.S. government of 0. It is, it's sort of, I think I had, I don't remember exactly what I said, last week, but you have an environment that you're living in. And part of that environment is that we have this crazy rule that says when we calculate our U.S. taxes, we can, if we want, ignore this box. And you need to have an appreciation of what that means. And this is a good example. Now, when this guy files his tax return, I simplified this by saying that, gee, the income down here was 100. This 100 might be the net of 1,000 of sales minus some amount of cost of sales, minus rent, salaries, local property taxes, all the expense items. So that this 100 is actually the net income of all those things. When G files his 1040, his Form 1040, he'll show 1,000 of sales. On the schedule, what is it, Schedule C for a proprietorship, for a business. He'll show 1,000 of sales. He'll show cost of goods sold. He'll show each and every individual item. Because under this fiction where we ignore this, all of these items of income and expense are his personal things, and he has to report each one of them. You really ignore this. Now, let's pretend for a moment that he did not make this disregarded entity election, and rather he used the default rule, which meant that this, because it's let's say a limited liability company, is going to be treated as a corporation for U.S. purposes. How does this tax computation change now that we are treating for U.S. purposes this X as a separate taxable person? How do things change?
Well, he doesn't have any income until the distribution back up or dividend back.
Yeah, excellent. Number one, this is a separate entity. It's not the same as him personally. And as a result, the income of X is not the income of the owner. The owner will only have income when there is a distribution. a distribution which is treated as a dividend.
Repatriated, right?
Yeah, repatriation of foreign earnings is the general expression. And in terms of, let's say, specifically trying to apply U.S. law to this, you would say, okay, X has made a distribution. You then look at Section 301 to decide, okay, what's the character in the hands of the recipient of that distribution? And what 301 tells you is, to the extent of earnings and profits down here, you will have dividend. If the distribution exceeds the earnings and profits, you have return of capital. And once you return all of your capital, any excess distribution is capital gain. Now, those are U.S. rules. X does its books and records under whatever the statutory accounting rules are in country A. They may or may not be anywhere close to U.S. earnings and profits methods and so on. Now, I don't want to get into this area right now because that's unduly complicates the point. So let's just assume that this 100 minus 40 of 6 and 60 net, that's the earnings and profits. And let's assume that, yes, there's a dividend distribution of 60. So as Ronnie was saying, what we have here is, oh, I'm sorry, you're bent. Oh, you were originally sitting over there, and you were supposed to be told to sit over here because you were switching seats. But we'll pass that one for the moment. Anyway, the point is that when he receives a dividend, and we are treating this as a corporation, now we're getting back to your 60 of income, and that 60 is in fact a dividend, and dividends are taxed in particular ways under U.S. tax rules. The general rule is that it's going to be taxed at your regular your regular individual rate of 35%. Can the individual take any foreign tax credit for the taxes paid down here? $100 of income, 35% tax rate, so he has 35 of tax. Can he take any foreign tax credit? Was he the taxpayer for this tax?
Isn't the income 60 though?
Oh, I'm sorry. Yes, you're right. Thank you. Yes, absolutely. The income is 60, and the 30. What's 35% of 60? What is that? Was that 21? 30? Yeah. Okay, so 21. So there's a tax of 21. Now, can he claim any foreign tax credit? Correct. No, he cannot. So at the end of the day, he has received let's see, 60 minus 21, which gives us what, 39? He ends up with 39 in his pocket at the end of the day. And that's in comparison to the disregarded entity situation where he ended up with 60. Now, this is just one example of how disregarded entity status versus corporate status can make a big difference. What if he sets up this company and it has startup losses? It has startup losses, and let's assume he is wealthy and has some other income in the United States. Does that loss offset his income from other sources? If it's a disregarded entity, yes, it perhaps can. If it's a corporation, the loss is the loss of a separate person. It's not his loss if it's a corporation. So it can make tremendous difference. Now, we can go through, we could go through similar examples where instead of G as an individual, we put a corporation up there. But I think in the interest of time, we'll move on. You will see as we get into more and more things, a lot of examples where it's a U.S. corporation owning a foreign subsidiary and seeing how it can make a difference one way or the other. Yes, Peter?
So he doesn't get credit for the withholding tax, the foreign withholding taxes?
Well, in this example, what foreign withholding tax?
That I guess that the foreign entity would be paying
Well,
the foreign government?
not every country, right here in this example, I'm assuming, for simplicity, that country A does not have a withholding tax on dividends. Since you bring it up, let's assume that there is a 10% withholding tax on dividends. What's the U.S. withholding tax on dividends paid by a U.S. company to a foreign company? Yeah, 30%. So this is just the other direction. A U.S. person receiving a dividend from another country company. Okay, so when this distribution is made, this dividend distribution, foreign country A says, okay, you're paying 60, well, we want 10% of it. So 6 goes to country A's tax authorities, and G up here receives 54. Now, is the gross income 60? Or is the gross income of the individual 54? 60. Okay, I happen to like that answer, but the appropriate question, though, is why did you choose 60?
The withholding is a tactic. The country's grabbing a piece based on the distribution to the individual. The individual is bearing the burden of that. 10%.
I agree with you, but you could also say that, well, gee, the individual is bearing the burden of the 40 at the lower level because he owns 100% of this company. So does that, are there any other thoughts as to why 60 is the right answer?
78 gross up?
No, that's for another day. Well, it's actually, if you think of it, you're right, but think of it this way. What is the event which caused the income? What's the event? The distribution. And what if you went and looked at the corporate documents for X LLC, what would you see? what did they declare? A dividend of 60. So the actual amount of the dividend is legally 60. Now, I might have an expense, of earning income. In the tax area, we gross things up. We look at what happens in each transaction. One transaction is that there's a dividend distribution, a declaration of a real legal dividend. It has real legal effect, and that dividend is 60. Absolutely right. And separately, I receiving this, or G receiving this, is the taxpayer for 6 of withholding tax. So the point is there's 2 transactions here. They are not netted for tax purposes. So yes, we have 60 of income, which gives us our tax of 21. And then because G, in fact, has personally the legal liability for this 10 of withholding tax, for this 6 of withholding tax, the 10%, we will subtract that 6 from the 21, and we will end up with 15 that gets paid to the U.S. government. Again, I'm ignoring going through the foreign tax credit limitation calculation and so on. But the point is, for a withholding tax, G is personally and legally the taxpayer. Therefore, he can claim the withholding tax. Yes?
That's for both scenarios, when X is a disregarded entity or a corporation?
Okay, no, it's not for both. This is only for X being a corporation. Okay, now let's go back and go through the same analysis, assuming that X is a disregarded entity, and maybe if we start a new sheet of paper, that would be helpful. Okay, we're treating this as a disregarded entity. And we're saying that this one, now notice, this is a disregarded entity. But again, it is still a legal entity in country A. If there's going to be a distribution of actual cash to the individual, the exact same legal procedure in country A at the offices of company X, the same legal procedures have to be gone through. Because we say this is a disregarded entity, the individual G cannot just reach in and take money because he says, well, gee, it's mine because the U.S. government says I ignore this. It doesn't work that way. It's still a real company. If there's going to be money out of it, the shareholders, board of directors, whatever, have to go through whatever legal procedures there are for a distribution. Now, for simplicity, let's assume all of this happens within one accounting period, within one taxable year. So obviously, we can make this as complicated as we want, but I think we want to make it simpler as opposed to more complicated. So we said that let's say there was 1,000 of sales proceeds. There was cost of goods sold of, let's say, 600, and there's other expenses of 300, coming down to within X a net income of 100, tax of 40, 60 of earnings and profits left over. Now again, because this is a disregarded entity, when he does his tax return in the United States on Form 1040, he will show on Schedule C, let's say, 1,000 of sales, 600 of cost of goods sold, 300 of expenses, and he'll come down to a net income from his business of 100. Now, let's say in the same year, to keep things simple, let's say that X does declare a dividend and declares 60, 54 goes to G, and 6 goes to country A. Now this 100 up here, we said there was a 35% tax rate on 100 of income. So his tax is 35 before foreign tax credit. And again, because of this fiction that we are ignoring that line, that box, he is considered to be personally a taxpayer for the 40 and the 6. So he has 46 of foreign tax and will therefore pay the same 0 to the U.S. government for on his Form 1040. So the only difference between this time and last time is that we've added the withholding tax, and it's treated in essence just like the 40 because of the disregarded entity status. He is considered to be the taxpayer, personal, on that 40. Okay, any other questions on this before we attempt to proceed? Yes.
So to test what you're talking about last week with Google, unless, maybe this is the complicated part you didn't want to get into, but if they did not declare a dividend here, the taxpayer, G, would still have to accrue it unless G was to say there's no plan at all to ever repatriate. So he would have to take the 46 foreign tax credit now.
Well, let's change it just slightly to deal with that. Here's Google, which we could call G if we wanted, and it has a company. Do you remember? I think they said it was it Ireland? I think.
Yeah.
Okay, so here's they've got an Irish sub, and this is being treated as a corporation. This is not a disregarded entity. Okay, and this Irish sub, because of various transactions, has accumulated a lot of low-taxed earnings from overseas operations. So the reason I want to change from this one is high taxed. The situation with Google or Cisco or any one of hundreds of large corporate groups is that they have low taxed earnings over here, and they want to make sure that those low taxed earnings are earned within an entity which is treated as a corporation. And your point, when you say accrue taxes, now we're getting to the financial statement side as opposed to the tax law side. If the Irish sub has 100 of accumulated earnings, and let's assume for simplicity there's no foreign taxes on that. No foreign taxes on that. They want to defer as long as possible the ultimate U.S. tax, which will be due at some time in the future when either a distribution is made or Google sells the Irish sub, or the Irish sub maybe loans the money back to Google, or does things which can trigger the income. Either an actual distribution, sale of the shares, or some other action that gives Google use of those funds. Now, part of Google's structure and whatever Cisco is doing, to get back to our disregarded entity points, is that probably the Irish sub has 1, 2, 3, 4, 10, 20, who knows how many other subsidiaries, and many of those subsidiaries will be treated as disregarded entities. So that from a U.S. standpoint, you have one foreign subsidiary. You do not have two foreign subsidiaries. You have only one. So this disregarded entity status or treatment as a corporation is extremely flexible. It's not just, how does Google up there treat the first tier? It's how do you treat the second tier and third tier and 15th tier? So in this case, the Irish sub is maybe operating in another country through what would be considered a branch. For tax purposes, part of the Irish sub. But for all other legal purposes, a separate legal entity. I don't know whether any of you have scanned, through the long case study, but one of the items in there is a supply chain structure. And this is something which is very commonly used, and it involves a lot of this kind of thing, where there's a company that will be the first tier company. It's treated as a corporation. And then there's other subsidiaries, some of which might be treated as corporations, some of which will be treated as disregarded entities. And you achieve certain goals, and to the extent you get into that case, and we'll talk about it some during class, to the extent we get into that, you'll see this in really glowing color of this kind of situation. I will attempt to remember to use some of these. A lot of times when you see charts of organization charts of companies, you'll see these kinds of boxes used. So it's good to be familiar with some of these. In other words, where the triangle is pointed upward, that's a hybrid, which is partnership for U.S. purposes or disregarded entity for U.S. purposes, and corporation for local reporting purposes. The reverse hybrid with the triangle pointed down, corporation for U.S. purposes, but transparent entity locally, partnership or whatever. Yes, Peter?
I'm just thinking about, isn't there a provision where you can exclude part of your income if you actually work abroad? And how would that impact the disregarded entity?
That's a good question.
If you're
It
actually
would,
working for
yeah.
that entity.
Yeah, what you're talking about, I think you covered last semester the 9/11 foreign earned income exclusion.
Yeah.
And the usual situation that happens in that kind of context is that an individual is an employee working for a company. So in that usual situation, this does not come into play. If an individual, though, works for himself, is self-employed, whether it's as a professional lawyer, whether it's a plumber, whatever it happens to be, where a person's self-employed, you can get the benefit of the foreign earned income rules. Now, what you're asking is, could an individual conduct his business through a local entity and still get the foreign earned income exclusion if he elects disregarded entity status? And while I've never looked at it, I'm quite sure the answer is yes, he could. Because this disregarded entity status for U.S. tax purposes is total. You really ignore the existence of that juridical person, and you pretend that all of its actions are your actions. And if you do that, and if all the other criteria are met, then the 9/11 exclusion should be available to you.